It all happened so fast. One piece of news. Markets around the world reacted in a flash. The day was January 30th, 2026. President Donald Trump made an announcement. He named his pick to lead the Federal Reserve. The name was Kevin Warsh. In moments, the financial world changed course. Investors did not wait. They moved their money immediately. What we saw was a powerful, synchronized shift. It was a clear signal that a new era for money policy might be starting. The reaction was swift, and it was brutal for some. It showed just how connected global markets have become. This was not a random event. It was a direct response to a single decision: the choice of who leads the Federal Reserve, one of the most important economic decisions a president can make. When markets shudder and asset prices swing wildly, it's often because of a single, powerful idea. To understand why the financial world suddenly sat up and paid attention, you need to know a name that carries immense weight in the corridors of power: Kevin Warsh. He is not a new face in Washington or on Wall Street. His career has placed him at the very center of American economic policy for decades. Before his time in public service, he was a key player at Morgan Stanley, specializing in mergers and acquisitions, giving him a granular, real-world understanding of corporate finance and market dynamics. This dual experience, bridging the gap between the theoretical world of policy and the practical reality of the market, makes his perspective uniquely influential. His most prominent role was serving as a governor of the Federal Reserve, the central bank of the United States. Appointed in 2006, he became one of the youngest governors in the Fed's history. Crucially, he was there during the tumultuous 2008 financial crisis. He wasn't just a bystander, he was in the room, at the table, as the global financial system teetered on the brink of collapse. He was a key liaison between the Fed, then led by Chairman Ben Bernanke, and the titans of Wall Street, helping to navigate the unprecedented bailouts and emergency liquidity programs. This experience, forged in the crucible of crisis, gives him deep, institutional knowledge of how the system works and how it breaks. He has seen firsthand the levers of power, the unintended consequences of policy, and the intricate plumbing of the financial markets. This isn't just academic theory for him, it's lived history. In the lexicon of central banking, he is widely seen as a hawk. This term is critical to understanding his philosophy. Policymakers are often categorized as either hawks or doves. A hawk is more concerned about inflation getting out of control and is therefore more likely to favor tighter monetary policy. They believe that keeping prices stable is the primary, most important mandate of a central bank, even if it means risking slower economic growth in the short term. A hawk at the Fed generally wants to keep interest rates higher to discourage excessive borrowing and spending, and they advocate for reducing the amount of money pumped into the economy. In contrast, a dove is typically more focused on promoting full employment and is more willing to tolerate higher inflation to achieve that goal, favoring lower interest rates and looser financial conditions. Warsh has consistently planted his flag in the hawkish camp. Since leaving the Fed in 2011, Warsh has been a vocal and often sharp critic of its subsequent policies. Through his writings and public appearances, he has argued that the Fed has done too much for too long. He believes the prolonged period of near-zero interest rates and massive bond buying, known as quantitative easing, created dangerous distortions in financial markets and fueled asset bubbles. He specifically and repeatedly called for the Fed to shrink its massive balance sheet. What does that mean? After the 2008 crisis, the Fed bought trillions of dollars in government bonds and mortgage-backed securities to push down long-term interest rates and encourage lending. This swelled its portfolio, or balance sheet, to an unprecedented size. Shrinking it simply means reversing that process, selling some of the bonds it owns, or letting them mature without reinvesting the proceeds. This effectively pulls money out of the financial system. This hawkish stance is the key. After years of easy money, a world of near-zero rates and trillions in bond buying that acted like a powerful tailwind for stocks, real estate, and nearly every other asset, the market suddenly had to confront the very real possibility of a paradigm shift. The mere mention of a credible hawk like Warsh gaining influence sent a clear message. The money spigot that had been wide open for over a decade could be turning off, and perhaps much faster than anyone had anticipated. The party, the markets seemed to fear, might finally be over. In the immediate aftermath of the Warsh news, the financial world didn't hold its breath for long. The first and clearest reaction detonated in the currency market. The US dollar, the bedrock of the global financial system, surged with astonishing force. To understand why this happened, we need to return to first principles. Think of the dollar not just as money, but like any other product. Its price, or exchange rate, is governed by the fundamental laws of supply and demand. When demand for the dollar outstrips its supply, its value rises. The news about a potentially more aggressive Federal Reserve was a massive catalyst for a surge in global demand for dollars. When investors expect the Fed to be hawkish, they anticipate higher interest rates in the United States. This creates what's known as a positive interest rate differential. Higher rates make holding dollar-denominated assets fundamentally more attractive than holding assets in currencies with lower interest rates, like the euro or the Japanese yen. Suddenly, you can earn more interest simply by saving your money in US dollars versus other major currencies. For large institutional investors, hedge funds, and corporations managing billions, this difference is not trivial. It represents a substantial, low-risk return. This is the essence of the carry trade, borrowing in a low-yield currency to invest in a high-yield one. The prospect of higher Fed rates made the dollar the undisputed king of this strategy. As a result, global capital began to pivot, seeking the superior yield and perceived safety of the dollar. Demand rises, the dollar goes up. This wasn't just a theoretical reaction, it was immediate and quantifiable. On January 30, 2026, the US dollar index, a key benchmark that measures the dollar's value against a basket of 6 major foreign currencies, spiked by nearly 1%. In the colossal multi-trillion-dollar-a-day foreign exchange market, a single-day move of that magnitude is a seismic event. The jump was especially significant because of its context. The dollar had been in a long, grinding decline, shedding about 11% of its value over the previous 12 months. The market consensus was that this weakness would continue. Then, in a single session, the entire narrative was upended. The trend suddenly and violently reversed. This reversal had profound implications. For the past year, a weaker dollar had acted as a tailwind for other assets. It made commodities priced in dollars, like gold, cheaper for foreign buyers, boosting their appeal. It also fueled risk-taking in assets like Bitcoin. But a stronger dollar changes the entire equation and has major consequences. Domestically, US exports become more expensive and less competitive on the global stage. Internationally, the pain is even more acute. Emerging market governments and corporations that have borrowed heavily in US dollars now find their debt burdens significantly heavier in their local currency terms. A strong dollar acts like a vice, squeezing global liquidity and financial conditions. This dynamic was not lost on policymakers. As Fed Governor Christopher Waller has noted in the past, dollar strength can directly reduce Bitcoin's appeal as an alternative store of value. The logic is simple and powerful. Why speculate on a volatile, non-yielding asset like crypto when the world's primary reserve currency is not only gaining strength but also offering you a higher, safer return? In the world of finance, money is a coward and a mercenary. It flees from uncertainty and flows to where it's treated best. Beyond these fundamentals, a powerful market dynamic was also at play: the short squeeze. For months, a huge number of traders had placed bets that the dollar would continue to weaken. This was a crowded trade. When the Warsh news broke, it was a direct threat to their position. To close their bets and cut their losses, these traders were forced to buy back dollars. This sudden, desperate wave of buying created a vicious feedback loop, pushing the dollar even higher and forcing more short sellers to capitulate. Those bets unwound fast. The message from the market was unambiguous. If the US dollar once again offers the trifecta of safety, liquidity, and now a superior return, capital will not just walk, but stampede back in. The king was reclaiming its throne. Nowhere was the pain more severe than in the precious metals market. Over the past year, investors worried about inflation and a weakening dollar had piled into metals. Gold had risen by about 65%, hitting new all-time highs. Silver's performance was even more spectacular. Just days before the crash, it touched a record $121.78 an ounce. These were seen as safe havens, a hedge against chaos and currency debasement. They were the ultimate debasement trade. Then, the Warsh news hit, and the floor fell out. Gold suffered its worst single-day loss in over a decade, plunging 12% to around $4,786 an ounce. For silver, the meltdown was catastrophic, down as much as 32%, the worst since 1980's Silver Thursday. Billions of dollars in value were erased in hours. Let's, break down this idea of the debasement trade. At its core, it is a simple concept, but its implications for investors and global markets are profound. It's a strategy born from a fundamental lack of trust. Investors engage in this trade when they fear a government or central bank is actively or passively weakening its currency. This erosion of value, or debasement, can happen for several reasons. The most common culprit is persistently high inflation, which eats away at the purchasing power of every dollar you hold. Another is a government accumulating massive, seemingly unpayable levels of debt, which signals to the market that the only way out might be to inflate the debt away by printing more money. And that leads to the third and most direct cause: the central bank creating vast sums of new money out of thin air, a process known as quantitative easing. When investors see these red flags, they begin to question the long-term viability of holding cash or government bonds denominated in that currency. Towards hard asset icons: gold bar, silver coin, property. When people lose faith in paper money, they turn to hard assets, real, tangible things that have held value for centuries, even millennia. We're talking about precious metals like gold and silver. Unlike a dollar bill or a digital entry in a bank account, you can't print more gold. Its supply is finite, governed by geology, not policy. This scarcity gives it an intrinsic appeal as a store of value when fiat currencies are being deliberately devalued. It becomes a form of financial insurance against policy error. For the past year, with central banks globally engaged in unprecedented money printing, the debasement trade was among the most profitable strategies. As gold and silver prices climbed, the momentum fed on itself. More investors piled in, fearing they would be left behind, pushing prices even higher. It was a crowded one-way bet on continued currency weakness. The nomination of Kevin Warsh to the Federal Reserve acted like a powerful switch, flipping this entire trade into reverse. Warsh was widely seen as a hawk, a policymaker inclined to tighten monetary conditions to fight inflation and defend the currency's value. His potential appointment signaled a dramatic pivot away from the era of easy money. Suddenly, the foundational assumption of the debasement trade, that the Fed would continue to weaken the dollar, was thrown into question. The market began to price in the opposite scenario: a Fed that would actively strengthen the dollar. This process is known as quantitative tightening, and it is the mirror image of printing money. Instead of buying assets to inject cash into the system, the central bank starts shrinking its balance sheet. It removes liquidity. This action makes dollars scarcer and, by the simple laws of supply and demand, more valuable. Every dollar in circulation suddenly has to work harder. This forces a massive, often painful, reevaluation of risk across every single asset class. The entire financial landscape begins to tilt. The core logic spread through the market like wildfire. A stronger dollar means higher interest rates. If you can suddenly get a safe, attractive, and rising yield from holding US dollars or government treasury bonds, why would you hold a non-yielding metal like gold? Gold pays no interest. It costs money to store and insure. Its only return comes from price appreciation. When risk-free assets start offering a real return, that is, a yield above the rate of inflation, the opportunity cost of holding gold becomes immense. This fundamental recalculation rippled through trading desks in milliseconds. Investors who were long gold and silver, betting on further debasement, were suddenly on the wrong side of a tectonic shift. They had to sell, and they had to sell fast. This wasn't just a change of heart. For many, it was a forced liquidation. As prices fell, leveraged investors faced margin calls, forcing them to dump their positions to cover their debts, which in turn pushed prices down even further. It's a vicious cycle where selling begets more selling. The exit door becomes very, very crowded. As the astute market observer David Rosenberg noted at the time, markets started aggressively reversing the debasement trade. The consensus narrative was no longer about hedging against a falling dollar. Instead, it was about repositioning for a future where the Federal Reserve actively defends, rather than debases, the world's primary reserve currency. The king dollar, it seemed, was preparing to reclaim its throne. The cryptocurrency market was not spared. It also felt the chilling effect of the Fed news. After hitting record highs in late 2025, it drifted lower. A new crypto winter. Optimism after President Trump's election, seen as crypto-friendly, began to fade. When the Warsh news broke, selling accelerated. Bitcoin tumbled below 66,000, lowest in over a year. On one day alone, Bitcoin slid over 7%. Other cryptocurrencies fell even harder. Ether sank about 12%. Bitcoin roughly 30% below its recent peak. Some see crypto as digital gold, some as a hedge against the system, but it often trades like a high-risk technology stock. A hawkish Fed means tighter money. Tighter money means less speculative cash. Cheap money. Investors take big risks on new assets like crypto. Expensive money. They retreat to safety. A stronger dollar undercuts the need for an alternative like Bitcoin. The downturn slammed crypto-related stocks, companies, employees, investors. The crypto winter suddenly felt a lot colder. Well, you know. While crypto and metals saw the most dramatic declines, the stock market did not escape unharmed. All the major indexes fell. The Dow dropped over 600 points as the S&P and Nasdaq posted significant losses. The selling pressure was broad. Fed policy worries weren't confined to a few corners. Higher rates make it more expensive to borrow and invest and make future profits worth less today. A new narrative emerged. The dark side of the AI boom, massive capex for compute, with skeptical returns. Fears that automation could disrupt business models and raise unemployment spread across sectors. Tech stocks that led higher were now leading lower. The Nasdaq 100 plunged 2%. As uncertainty rises, investors sell the riskiest assets first, especially high-growth names priced on distant assumptions. News of the Fed's potential new leader hit like a stone in an unstable pond. Ripples amplified fears and fueled the sell-off. The combination Fed fears and AI anxiety proved toxic. The risk-off mood spread across the system. Let's connect all the dots. It comes down to a simple chain of events, starting with the signal. The nomination of Kevin Warsh. The market interpreted this to mean two things: higher interest rates and less liquidity. When the Fed shrinks its balance sheet, it's like a sponge soaking up excess cash. Next, the dollar rises and bond yields rise. Holding cash and treasuries becomes more attractive. A higher-yielding 10-year treasury becomes a major competitor to every other asset. To buy dollars and bonds, investors sell other things: gold, silver, cryptocurrencies, and especially high-growth stocks. Leverage intensifies the move. Margin calls trigger forced selling, fueling a vicious cycle. So what can we learn from this sudden and violent market shock? The first lesson is simple. Policy matters. A single decision or announcement from the Federal Reserve can change everything in an instant. Markets do not wait. Second, all markets are connected. The dollar often sits at the center, the sun around which many assets orbit. Third, risk is always real. Assets that surge can also plunge. Crowded trades can turn dangerous when the story changes. The era of easy money that powered markets may be ending. The nomination of a hawk is a powerful sign of that shift. This does not mean you should panic. Be calm, careful, and aware. Watch the Fed's signals. Watch the US dollar. Understand that sentiment can change very, very quickly.